A fistful of gold conflicts determines market developments since the beginning of the year. We have mainly three of those gold conflicts. The monetary policy gold conflict, the corona-related gold conflict, and geopolitical gold conflicts. The monetary policy gold conflict was almost forgotten. But with the increase in inflation at the end of last year, it became evident that central bankers have to decide between their goal of low inflation and high economic growth or low unemployment. Now, in their policy setting, they have to take into account that economic developments are undermined by an increase in interest rates. Markets regard this as a danger, as it's not just a question of valuation, but the question is if a too strong increase in interest rates may abruptly end the economic recovery and reduce the corporate profit developments. The corona-related gold conflict is in between limiting the spreading of the virus and supporting economic growth. It seems that this gold conflict has been reduced recently by the Omicron variant, as this variation of the virus is not as severe in its impact on the health of the population as the previous virus mutations did. Nevertheless, we see that the conflict is still there, particularly in China with its zero COVID policy. In regard of the geopolitical conflicts, we have to watch developments in the Ukraine. There, Russia on the one side and the Ukraine and its Western alliance are clashing against each other. That may cause some disruptions, not just in the energy supply, but also in the whole geopolitical setup. On top of this, we have ongoing conflicts in Iran and in Taiwan. All of those conflicts could lead to disruptions in economic developments in the medium term. These conflicts come together in the question of inflation. If we get another session of severe lockdowns, this may disrupt the supply chains and we may see another increase in inflation around the globe. On top of this, an escalation, particularly in the Ukraine, may lead to a spike in energy prices. All that would increase the gold conflict of central bankers as inflation stays high and they have to make a decision between inflation and growth. In our base case, we still assume that inflation comes down in the course of the year and therefore monetary policy will be coming up with a rapid increase but not an aggressive one. In this respect, we think that markets over time will develop positively. Nevertheless, the risks are clearly geared to the upside in the term of inflation, and this means that the risks for market developments are on the downside.